Ladies and gentlemen, good day and welcome to Go Fashion India Q4FY22 earnings conference call hosted by DAM Capital Advisors Limited. As a reminder, all participant lines will be in the listen-only mode and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Rajiv Bharti from DAM Capital Advisors. Thank you, and over to you, sir.
Thank you, Neerav. Good morning, everyone. Representing DAM Capital, it's our absolute pleasure to host Go Fashion India Limited for its Q4 and full year 2022 ending conference call. The company is represented by Mr. Gautam Sarogi, Chief Executive Officer, and Mr. R. Mohan, Chief Financial Officer. Over to Gautam for your opening remarks, and post which we'll open it for Q&A. Thank you.
Thanks, Rajiv. Good morning and a warm welcome to everyone present on the call. I hope you all are keeping safe and healthy during these times. I would like to mark a thank you to the entire investor community for the tremendous support during the IPO in November 21. It was a proud moment for all of us. Along with me, I have Mr. R. Mohan, our Chief Financial Officer, and SGA, our Investor Relations Advisors. Hope all of you have received our investor deck by now. For those who haven't, you can view them on the stock exchange and the company website. FY22 has been a challenging year for this industry, and despite COVID-related lockdowns, our company has shown great resilience and we have come out stronger than ever before. We are among the few apparel companies in India to have identified the market opportunity in women's bottom wear and have acted as a category creator for women's bottom wear. We have strengthened our portfolio by adding new products across all bottom wear categories. We have leveraged the advantage to create a direct-to-consumer brand with a diversified and differentiated product portfolio of premium quality products at competitive prices. During fiscal year 22, our volumes grew by 34%, and despite the lockdown phase in January, our volumes for the quarter grew by 11% on a YOY basis. We have a strong unit economics with an efficient operating model. We have a standardized and scalable developed model for our EBO base, and we have the know-how and experience for the same. Our unit economics has allowed us to expand our EBO network across various regions in India, including new EBOs in Tier 1, Tier 2, Tier 3, and Tier 4 cities and towns. During fiscal year 22, the company has added 54 EBO stores, and we have crossed the 500 store milestone during the last quarter. Keeping in line with the growth strategy to open more doors closer to the consumer, the company is pushing ahead with expansion. We continue to invest expanding our store footprint across geographies by adding 120 to 130 new stores every year. We are looking at omni-channel engagements for a seamless consumer experience, building on a technology-driven growth strategy to reach customers across all cities. Our products being core and essentials to consumers have enabled us to operate on a business model where we offer limited discounts, and sale of our products is typically at full price. In our experience, results in greater profitability. 97% of our EBO sales for fiscal year 22 are all on full sale. In addition, our EBO's average selling price has increased primarily on the account of value-added products that we have introduced as part of our portfolio. Our ASP for fiscal year 22 is rupees 661 per unit. We have strategically undertaken brand building initiatives to gain visibility with prudent use of resources while incurring limited branding and marketing expenses. We retail our product under a single brand for improved brand recall and better marketing of our product, which has yielded one of the highest revenues per unit spent in the sector. We are leveraging technology to bring cost efficiency and enhance consumer experience. We intend to further improve our operating efficiency and ensure efficient supply chain management through global best practices. Among the measures that we intend to undertake include investing further in the infrastructure to improve productivity and time savings. We will look to upgrade our warehouse to optimize our inventory and supply management. We intend to implement new technologies to further expand and improve customer deliveries and enhance customer buying experiences with faster dispatches. We also undertake data analytics, and that will allow us to better understand customer preferences, improve sales, and help scale our operations. We are also in the process to add and identify another small warehousing facility in Bhiwandi in Maharashtra. We continue to focus on further strengthening our online sales to benefit from evolving customer trends in the market. We propose to make investments in digital channels to improve our omni-channel engagement experience for our customers and have a dedicated team for the e-commerce operations. We also intend to leverage our existing capabilities to increase our online presence by improving and upgrading our website. Our focus will be to target customer acquisition to drive sales through our website and online marketplaces. In addition, we intend to invest in content generation to build engagement with the younger audience. We look forward to continue to innovate and with a creative approach and launch more products while providing more brand destinations for our consumers, which will help us grow and gain market share in the coming years. With this, I would like to hand over the call to our CFO, Mr. R. Mohan, for the update on the Q4 and FY22 financials. Thank you.
Thank you, Gautam, and good morning, everyone. The company has posted a strong performance for the quarter ended 31st March 22, backed by an increased demand across product categories. Our revenues for the quarter stood at 116 crores as against 90 crores in Q4 FY21, registering a growth of 29% year-on-year, led by the volume growth of 11%. Gross profit increased by 30% to 72 crores, with the GP margins of 61.8 for the quarter. Our EBITDA for the quarter stood at 38 crores, registering a growth of 53% Y-on-Y as compared to 25 crores in Q4 FY21. Our EBITDA margins, which stood at 32.4%, have seen an improvement of 490 basis points on a year-on-year basis. Profit before tax for the quarter stood at 15 crores at a 61% YOY from Q4 FY21. Profit after tax for the quarter stood at 12 crores, 73% YOY growth over the FY21 Q4. Coming to the same-store sales growth, we have seen a 17% SSG if compared to Q4 FY21, that is last year, and an SSG of 31% for the second half of this year. Coming to the financials, FY22, our revenue stood at 401 crore as against 251 crores in FY21, registering a growth of 60% Y-on-Y. Our EBITDA for the year stood at 119 crores as compared to 46 crores in FY21. Our EBITDA margins, which stood at 29.7%. Profit before tax for FY22 stood at 48 crores, whereas profit after tax for FY22 stood at 36 crores. SSG for FY22 is not comparable due to COVID-related lockdowns. With this, we now open the floor for question and answers.
Thank you very much. We'll now begin the question and answer session. Anyone who wishes to ask a question may press star and one on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and two. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. Participants, you may press star and one to ask a question. The first question is from the line of Ankit Kedia from Phillip Capital India Private Limited. Please go ahead.
Hi, sir. So I have three questions. So first is on what could be the volume growth in the SSG of 17% for the quarter, which you have posted, given that the ASP increase itself YOY is around 13%?
So, Ankit, the volume growth would be about 5%, I think.
Sure. And you have also taken a price increase in the month of December and January of 50 rupees on the leggings. But if I look at your quarter-on-quarter ASP increase, it's virtually flat. So have we seen downtrading from the consumer side, or it's more of a mix change wherein the quarter 3 is high festive demand and winter wear, and we will see the benefits of the price increase in quarter 1?
So, Ankit, the way it works is, whenever we increase the prices get increased for the newer pieces which comes out from our production, from the outsourced production. So, till those new pieces gets into the system and we start selling on the new price, it takes time for the transition to happen. So, basically, the inventory which is placed at the store level and the other channel level, we are not changing the price for the existing inventory. So the price increase of 50 rupees, what you're talking about, it will show over a period of 2-3 quarters. It will not show immediately in quarter 1 or quarter 4.
Sure. Sir, so in that case, our inventory has seen a significant bump up for the year. While you have always guided 90 to 100 days of inventory, it's more than 150-day inventory today. So what is the reason for the, inventory bump up in the system?
Yeah. So I'll explain the logic. I'll take a few minutes, Ankit, to explain this because this is a very important point. So see, Ankit, there is right now a very big supply chain issue which is happening because, raw materials prices have been fluctuating. The cotton has become a little scarce in availability. So there is a lot of supply chain difficulties what the apparel industry is facing as far as cotton and fabrics are concerned. Now, so we had built up inventory, keeping in our growth in mind what we want to do over the next few quarters and few years. And immediate future, we have buffed up inventory so that we don't get affected by the external factors. Now, today we are having about 165 crores of inventory. Vis-a-vis, we had 80 crores of inventory in March 21. So our inventory is almost doubled. But if I take inventory days as a calculation of what is my current running sale number, see, currently we are doing an average of 47 to 50 crores of monthly average sale. So if I take my current monthly average sale number and then I compare the inventory what I'm holding, I'm holding about 3.2 months of inventory, which is about 95 to 97 days, which is very much under control and in line with what our inventory planning is to begin with. So two things here. One is obviously we have bumped up inventory keeping in mind the supply issues which is happening in the market. Second, most importantly, even if I take my current inventory number coinciding with what sale number I'm currently doing, which is about 47 to 50 crores on a monthly average, I'm having about 3.2 months of inventory, which is pretty much under control.
So can you give us a breakup of finished goods inventory and raw material inventory?
Yeah, sure. So finished goods so raw material inventory in that 165 crores would be about 45 crores, if I'm not wrong, around that number.
Okay. Sir, two more questions from my side. One is on your online sales. In FY22, we only saw 3% growth while the company growth was 60%. While you have invested a lot and, about online being the key pillar for growth, why is only 3% growth in the online for the system?
See, currently online, it's a very, very important channel, but like I had mentioned last time also, it will grow at a slower speed compared to offline. See, currently what we are doing is we are building our new website a few months ago, which has now the new website has already gone live. Now since the new website is live now, we are building the omni-channel strategy. So this push from 3% to probably say double digits in the coming quarters is that the work in progress is starting to happen now. Since our new site is up and running now, we are building the omni-channel where we are integrating the new site with our front-end retail. So keeping these things in mind, the online sales will start picking up in the coming quarter.
Sorry to interrupt you, Ankit. I'll request you to come back in the question queue for a follow-up question. A request to all the participants, please restrict to 2 questions per participant. If time permits, please come back in the question queue for a follow-up question. The next question is from the line of Devanshu Bansal from Emkay Global Financial Service. Please go ahead.
Sir, thanks for the opportunity. Just in continuation of earlier question on inventory, just wanted to check. I understood that the current revenue base is also low, and given the higher monthly run rate, the inventory levels are higher. But at FY23 end, should we inventory levels be at 90-95 days? Is this a correct understanding?
See, I mean, we are going to be looking at maintaining similar levels of 90 to 95 days a month.
Sure. And in terms of channels, you have indicated that ABO to contribute about 80% mix. So just wanted to check as in what is the timeline to achieve this sort of mix?
Sorry, Devanshu, I missed your question. Can you please come again?
So in the presentation, you have indicated you expect EBO channel to contribute about 80% to your overall revenues. So I just wanted to check the timeline for that.
So Devanshu, it's very hard to specify exact timeline. but we are hopeful that maybe over the next 1.5 years or 2 years, we should get to that number.
Okay. And for the rest 20%, so if we see online channel, you have indicated that you have sort of good plans there. So majority of that share shift will happen from LFS. Is this a correct understanding?
See, I'll tell you what is our eventual plan. Eventually, in 2-3 years down the line, what we are planning to see is that EBO and online together should calculate, which is a direct to consumer, EBO and online together should contribute to 90% of the sales. Where LFS share comes down below 10%, and our MBO and other channels would be less than 3%. So this is our eventual mix, what we are planning to achieve in the next 2 to 3 years, where 90% of our sales is coming from EBO and online together.
Sure, got it. Sir, just in as a follow-up, but LFS in this quarter has particularly seen about 150 sort of store additions. So from that perspective, store additions have been sort of particularly strong. And so interestingly, even tier 2, 3, 4 towns actually added about 100 stores of those 150 stores. So just wanted to check, so what are the plans in terms of store additions for LFS format?
See, so Devanshu, what we are doing in LFS is we are very selectively growing with our partners. It's not that we are going everywhere and adding stores across the country. It's not like that. Selectively, where our target markets and strategy are, we are selectively adding those stores with LFS partners, because LFS is a very, very important channel. It gives us access to newer towns, newer geographies. Before we can think about opening our EBOs also, it gives us a taste and flavor of that new city. So we are going to continue to expand, and this last 1 year we've been able to add a good number of LFS stores, and I'm hopeful that even in fiscal year 23 we'll be able to add a good number of stores.
Okay. Lastly, wanted to check what are the kind of investment in terms of OPEX as well as CAPEX for the online investments that you have indicated for the coming year?
So Devanshu, see, as far as online and omni is concerned, it's not a very cost-heavy or very investment-heavy channel, frankly. See, our new site, what we wanted to do live, we have already got it live. Our new site is ready. Our front-end EBO software and our back-end SAP software also is ready. Integrating the 3-4 and omni-channel experience is not going to be very capital-heavy. It's going to, so the investments in digital are not going to be very material.
Sure. So I wanted to check from team perspective, as in you indicated investment in team, warehousing, etc. So anything to watch out there?
See, on the e-com front, we have hired a dedicated e-com team who understands e-com in and out. See, we are more of an offline business, right? We are more of a brick and mortar business. So now we have one dedicated team for e-com and online who their entire focus is only online, and they are not focused on offline at all. So for them, this team, what we have formed over the last few months, we are starting to see good results. So we are hopeful that this will add and help us grow our online.
Thank you, Devanshu. I'll request to come back in the question queue. Participants are requested to ask 2 questions per participant. The next question is from line of Vaishnavi from Anand Rathi. Please go ahead.
Hi, thanks for taking the question. So 2 things. So one on the inventory build-up, right? So do we expect sales growth to probably accelerate at a faster rate versus what we have seen in the last 1 year if we have so much of inventory build-up?
So Vaishnavi, very hard to link the two. I think sales are largely driven by market sentiments and how consumer behavior is happening. Our idea of building inventory was more from the perspective of there should not be any stoppage in supply chain or break in supply chain. But it will be hard to say that because of higher inventory we would be able to sell a lot better. Would be a hard assumption. But we are quite now, since consumer sentiments are anyway back after the third wave, we're very hopeful that the sales over the next couple of quarters will be very strong.
Okay, and my second question is on the pledge that was done in the last quarter, right? Any specific reason for the same?
So Vaishnavi, our pledge was for personal reasons. Our requirement as a family, as a promoter family, was 150 crores. And we had taken that for, this pledge was specifically taken for personal requirements and commitments. And this is short-term in nature. We understand the sensitivity around this subject. And this is short-term in nature, and we are looking to close the pledge within 3 to 6 months.
Okay. 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 Thank you.
Thank you, Vaishnavi.
Thank you. The next question is from the line of Akhil from Centrum Broking. Please go ahead.
Hi. Thanks for the opportunity. My first question is on the store closure. So what is the policy or the time frame we apply, given that we see a significant store closures which have happened over the last 4 years? Almost 85 stores have closed. So what kind of policy we look at this in terms of store?
Yeah, sure. So see, as far as store closures are concerned, see, if you take most of the store closures that have happened in the last 2 years, it's largely related to COVID, because post-COVID first wave and second wave, there were many markets which didn't revive. There were many malls which didn't revive. So we had no choice but to exit. So a large number of those closures will pertain to COVID. In general case scenario, our closures have been limited. And we usually at least wait for a year or year and a half to assess the performance of the store and then decide whether we want to close or not.
Sure. And my second question is on expansion in tier 2 and tier 3 towns. We have significantly added in tier 2, tier 3 and tier 4 towns. So what kind of rent to revenue ratio we look at, and how does the store dynamics differ in these cities versus the metro and tier 1?
Yeah, sure. So see, if I compare tier 1 versus tier 2 and tier 3, the real disparity between tier 1 versus tier 2, tier 3, tier 4 will be slight in revenue. See, the kind of revenue what we generate for an average store in a tier 1 versus a tier 2, there will be small delta difference. Obviously, a tier 2, tier 3, tier 4 will be slightly lower than a tier 1 city's average store. Having said that, the other economics of the business as far as rent to revenue ratio is concerned, salary to revenue ratio is concerned, or EBITDA as a percentage of revenue is concerned, that is pretty much same, because in tier 2, tier 3, tier 4, the costs are that much lower. So for us, the rent to revenue and the EBITDA percentage does not change. It's only the numerator, the revenue changes slightly between a tier 1 and a tier 2. Having said that, the kind of rent to revenue ratio is what we look at while finalizing a store in a tier 3 city or a tier 1 city. We look at about 15% of rent to revenue ratio when we finalize.
Okay, and just one follow-up on this. Our brand equity in tier 2 and tier 3, I'm assuming, will be a bit lower as compared to tier 1 and metro city. Would that interpretation be correct?
I would say our brand recall would be slightly lower in tier 2, tier 3, tier 4, because right now our presence, if you see in terms of EBO network, we are largely the top 8 cities. So yes, it would be that a brand recall would be lower in tier 2, tier 3 as of now, because our presence is low.
That's all from my side. Thank you so much.
Thank you. The next question is from the line of Gautami Desai from Chanakya Capital Services. Please go ahead.
Sir, I just wanted to know your experience on value-added items. Experience in the sense that what would be your competitive advantages, and also I would tend to believe that in those items there are established brands, and hence your experience will be very different to your leggings, which is your mainstay. So that's my first question. And another question is, are you able to pass on the cotton prices, the high-tech cotton prices completely, or have you done any change in the fabric mix?
Okay, yeah, thanks, Gautami. So first on the value-added products, see, look, for us, one of our key strengths is product innovation, right? So there have been many products which we have innovated and developed in-house, and then we have bought in the market. Like, for example, a very important value-added product we had launched 3-4 years back was the kurti pant. The kurti pant was a product innovated and developed in-house. So our strength is our product innovation, and definitely value-added products have given us the edge over our competitors. And one of the reasons for our consumer to keep coming back to our Go Colors store is not only for the variety in colors what we have in our leggings and churidars, but for the kind of range of other products we have across jeggings, pants, harems, patialas and palazzos. So our value-added product strength is one of our key strengths in terms of our consumer sales. Now, coming to the cotton price increase, see, we have not changed the composition of the fabric. We believe that one of our key selling points is the quality of a fabric. So we have not touched the fabric quality at any point. We have whatever our long-term price increase, what we have seen in raw materials, that much increase we have taken at the selling price. See, when there are short-term fluctuations in price, we don't really increase our selling price. We absorb it because our gross margin gives us the room to absorb it. But whenever there are long-term fluctuations in price, we correspondingly increase the selling price. So we increase the price without touching the quality of the fabric.
So whatever the price has happened, price hike, that much you feel that with this 50 rupees it will get covered?
Sorry, can you come again? I lost in between.
Whatever price hike that has happened in your fabric cost, this 50 rupees price increase which you have taken, will that cover that cost?
See, we have taken two price increases, Gautami. One we have taken in April 2021, and one we have taken another increase in December 2021. So these two increases, what we have taken over the last year and a half, will cover that increase in price, in raw material price, without any cost.
Okay, and sir, you say that your LFS is going to come down to 10%. I mean, that's what you wish for. So then in that case, would your inventory go down below 90 to 95 days? Because then I don't see that, any reason for your inventory to stay so high.
No, see, inventory, Gautami, we are maintaining 90 to 95 days consciously. See, we want to maintain inventory in 90-95 days because we are in a high growth business, and in some sorts our inventory does not have any risk because there is no fashion element. So at a company level, in the short term future, we want to maintain 90 to 95 days of inventory for faster growth.
Okay, otherwise what changes in your working capital you foresee if you can bring down your LFS to less than 10%?
Sure. So, Gautami, what will happen is our receivables, which are at about 50 days, would start coming down to about 25-30 days. See, I mentioned on the call that our current revenue number is between 47 to 50 crores. So if I take the 60 crores of receivables what I have in the balance sheet and compare it with my current running number, my receivable days is already at 35 days. So my overall receivables as a percentage of revenue comes down, which further decreases my working capital.
Okay. And so what we are seeing in not only you but most companies is that this continuous rise in the inventory cost. What that has done is that it has revised the price, the costing. I mean, the overall value of the inventory. Right now, you have a high level of inventory, and obviously when you value it, it will be at least 25 to 30% higher than what it was. So, is there an impact of the same on your margins?
No, see, our inventory is calculated on cost on an average cost basis. So because of the raw material prices increase, what is happening, our older inventory value does not increase because we work on an average cost. Our older inventory will lie in the system at the older cost, and the newer inventory will be on the newer cost. And then the system calculates the inventory valuation on an average cost basis. So our inventory valuation, overall inventory value in the book does not change with the increase of raw material price.
Okay. Thank you, sir. Thank you so much.
Sure, got it.
Thank you. The next question is from the line of Manish Poddar from Motilal Oswal Asset Management. Please go ahead.
Yeah, hi. Thanks for doing the call. So, primarily three questions. First one is, would you be able to help me with the channel mix or sales mix that's in the base quarter, 4Q21?
So right now, this quarter 2, we had a channel mix of where EBOs have contributed to about 74% of the business.
Gautam, the base quarter, 4Q21. Let's say I have this quarter mix is there in the PPT. I'm just looking at the base quarter, 4Q21. 4Q21, the base quarter. So like you mentioned, 74.3% is in this quarter. I'm just trying to understand the base quarter, March of 21. How much was that mix?
Oh, at that time,
75.3.
Yeah. Oh, basically, YOY. You are talking about last year same quarter. Okay.
Right.
I think at that point of time it was around 72%. So the mix was very similar. So EBO has increased from 72 to 74%.
Also, it is 76.3 last time.
75%. Okay, so I stand corrected. Last year same quarter, EBO contributed about 75%.
Okay. So, then the margin mix stands fine. Okay, just then probably two more questions. First one is, let's say if you look at your Q1 now, the coming quarter, just wanted to understand, how would you judge the performance? Because, last 2 years, the first quarter has been a whitewash and Q4 had this Jan impact. So, when you're judging your performance in the next quarter, would it be, let's say, percentage of what you did in December quarter, or how are you internally looking at it, or let's say guiding the team for this quarter?
Yeah, see, very rightly you asked, Manish. So we are going to be looking at on month what growth we are going to be doing. So because actually for us to compare, we can't compare anything with last year, first quarter and the year before that because of COVID. So we would be internally comparing with our previous month's number and see how much we are growing month on month based on previous trends. That's the way we would be looking at it. Because on quarter to if I have to compare it on a YOY basis, it will be difficult because last year the entire first quarter was affected by lockdowns, and the year before that also was the same thing.
So just any sense, let's say, so this quarter, Jan, Feb, March, how are the numbers stacking up? Would it be, let's say, 20, 40, 40? Is that a rough split?
Sorry, Jan, Feb, March? I didn't understand.
This quarter, when I'm looking at, let's say, monthly number, would Jan, Feb, March be a split of 20, 40, 40? Let's say if you did 100 rupee sales during this quarter? Just a broad ballpark.
See, broadly, I'll tell you. Like, so in March, we did broadly between 47 to 48 crores of revenue in March.
Okay.
And
okay.
Yeah, so it's yeah. So
I'm just looking at the end number. So that is fine. Just one last one, if I can. Just on this warehouse bit. So you're putting up a warehouse, like you mentioned, in Bhiwandi, in Maharashtra. What is the capex outlay? And I thought earlier the warehouse in South India was enough for your entire expansion plan. So just why is the change in thought? And let's say what is the capex outlay here? Thanks.
Yeah. So Manish, see, it's a decently small warehouse. See, it's not even like a warehouse. It's just like a small mini fulfillment center. And I'll tell you the reason why we are doing it. See, West contributes to a very large portion of our business. And what we've noticed that from Bhiwandi, even North can be catered very well. So we said, look, let's try out with a mini warehouse, like a mini fulfillment center, to see if we are able to improve our efficiencies of sale and dispatch for the stores in West and South. So West and North. So it's a small warehouse, and the capex what we are looking at will not be very material in nature. From what we understand, it will be about 2 to 3 crores, and not more. We have identified a location, but still the capex plan is yet to be full and free, but it's not going to be material in nature.
Got it. Just a small feedback. If you can incorporate, let's say, the base quarter numbers, let's say for the channel mix, and let's say if you can include the pre-Ind AS margins, let's say on a quarterly basis, or let's say at least on an annual basis, that'll be helpful to understand the performance.
Sure.
Thanks so much.
Thank you, Manish. Yeah.
Thank you. The next question is from the line of Aniruddha Bhandari from 16th Street Capital. Please go ahead.
Yeah, congratulations on good numbers. My question is on cash flows. So why are the cash flows from operations so low? EBITDA is 119 crores. What is causing the difference?
See, I think the major reason for our cash flows to be on the lower side is because of the increase in working capital, and largely driven by inventory. So our inventory in March 21 was 80 crores, which has gone up to 165 crores. So one of the reasons for lower cash flows is because of the increase in inventory, which explained earlier that it's because of the supply chain difficulties what we are seeing in the market right now.
And what are the receivables pertaining to? I mean, all your EBOs are company-owned, company operated, right? So most of the receivables are pertaining to LFS, sales of sales.
Yes, absolutely.
And how is the arrangement there?
Sorry?
What is the arrangement of receivables, and do you also take the stock back if it doesn't sell for a few months?
Sure, I'll explain that. So Anirudh, very rightly you pointed out. So the receivables what you see in the balance sheet are largely driven by large format stores. So the 60 crores what number you see in the balance sheet is most of that is LFS. We sell to LFS on a SOR basis, which is a principal to principal relationship. So according to accounting standards, we need to show it as debtors in our book. Now, as far as returns are concerned, ours is a very core and essential web product. So we have actually not seen goods coming back in large quantities from the large format stores as returns. Our returns percentage has been under 1%.
Under 1%, okay?
So under 1%, 1%.
Okay, got it. And what investments are we doing to improve this ratio, cash flow to EBITDA? It's very low, and it's not consistent over last 4 years as well.
No, see, I think, look, as the sales increases and the inventory gets normalized, the requirement of increase of working capital will not be so high as we've seen in fiscal year 22. So automatically, the cash flow from operations will automatically improve.
Okay, got it. Thank you.
Thank you. The next question is from the line of Rahul Jain from Phillip Capital. Please go ahead.
Hello. Yeah, I have a couple of questions. My first question is, are you facing any pressure on job work charges given the increase in cost in Tirupur?
Yeah, hi Rahul. Thanks for the question. So Rahul, we are not seeing any pressure or increase in charges of the job work and the factory charges in Tirupur. I think it's largely been driven by the material cost of fabric. But as far as subcontracting and the factory charges and job working charges are concerned, it has stayed pretty consistent. We don't see any fluctuations there.
Okay. And my second question is regarding the absolute A&P spend. The cost has declined 20% to 5 crores against 6.4 crores in FY21. What is the guidance going forward for A&P spend?
See, usually, Anirudh, we will be, this year has been lower because this year was a COVID impacted year. So we were very frugal in our advertising spend, to be honest with you. In a normalized year, we would be around 2 to 3%. On a long-term average, we would be 2-3%. There would be some years where we might touch 4%, but on a general normalized basis, we will be at around 2 to 3% of revenue.
Okay. And could you share the total EBO area and average area per store, if possible?
Yeah, so our average area is around 400, about 390 to 400 square feet. Average area of our store.
Okay, thank you.
Thank you. The next question is from the line of Rehaz Mehta from GreenEdge Wealth. Please go ahead.
Yeah, hi. Thanks for the opportunity. Resha this side. So I have two questions. One, if you could, talk about, in terms of the future revenue growth, how much of that will come from volume growth and how much from product mix or premiumization? And also if you could talk about, you alluded to value-added products. So how do you define value-added products? What is their average selling price?
Sure. So see, I'll take the second question first and then I'll come to the other one. See, from a value-added product perspective, how do we define value-added products? See, leggings and churidars are your core generic bottoms. Value-added products are anything like pants, jeggings, harems, patialas, palazzos, leggings. They come under the value-added mix. Now, the value-added products for us contribute to almost half of our business. Earlier, leggings and churidars used to dominate it, but now the value-added products are contributing to almost half of the business. The average selling price of the value-added products would be around 800 to 900 rupees a unit. See, what we are doing as far as pricing our products are concerned, we try and price a product as low as less than 1,049. So for us, 83% of our entire product portfolio won't be listed less than 1,000 rupees because consciously we want to price our product right with very high quality. So our average selling price for a value-added product would be 800 to 900 rupees per unit. As far as future growth is concerned, see, we are as a company looking to grow at a CAGR of more than 20% over a long period of time because our category is very huge. And maybe in the coming years, our growth would be higher. It would be slightly higher, around 30 or more than 30%. But on a long-term basis, we are looking to grow at a CAGR of around 20% as far as revenues are concerned.
Got it. And how much of this would be from the volume growth driven versus product mix or premiumization change?
So, for example, or if suppose I'm looking at a growth of 30% in the immediate couple of years window, probably 15 to 20% should be volume.
Got it. And just to follow up on this, right? So how much would athleisure be, a part of your overall revenue mix? And also in, jeggings, track pants, etc. What would be our right to win, versus let's say somebody like Page or Enamour, who are operating at broadly similar price points?
Yeah, see, for us, athleisure right now is a very, very small contributor. See, for example, all the newer products what we have launched in loungewear and athleisure, we are just in the first year. It takes a few quarters, it takes a couple of years for a category or a product to settle down. So if you see right now as a contributor to sales, it will be a very, very small percentage. But one of the reasons why a customer is coming back to a Go Color store is the range of colors and the range of products what they find under one roof, right? So today when a customer is coming to a Go Color, she's finding the athleisure bottoms, she's finding the western wear bottom, she's finding the fusion wear bottom or ethnic wear bottom under one roof. That is our value-added proposition. Our value-added proposition is basically getting all the products, all the colors of bottom wear under one roof. That is where we have that selling edge.
Resha, sorry to interrupt you. I'll request you to come back in the question queue for a follow-up question. A request to all the participants, please restrict to one question per participant. If time permit, please come back in the question queue for a follow-up question. Requesting participants to restrict to one question per participant. The next question is from the line of Manasvi Shah from ICICI Prudential. Please go ahead.
Yeah, hi sir. Thanks for the opportunity. So, just two questions pertaining to inventory. One is, what is the aging of your finished goods? If you can answer that. And second, what would be the quantum because of revaluation this time? Because raw mat cost and NRV has gone up, right? If you can just explain both of these.
Yeah. See, our finished goods, most of our finished goods are under 1 year. See, we have a provisioning policy also, Manasi. So inventory which is greater than 365 days old, we provide for it. And this year also we have, as per the policy, provided for inventory in our books, which is a very relatively smaller number. So if I take the inventory aging of our finished goods and raw materials, it's well within 1 year.
And this provisioning is less than 1%?
I'm sorry?
The provisioning is less than 1%?
Okay. Yeah, it will be around 1%. I'm not having the exact percentage handy, but it will be around 1%.
Okay. And on the second question?
On the second question, see, like I explained, our inventory valuation does not change with the increase of raw material pricing, because in the books, the cost of inventory will be always based on when it was purchased. So the system throws out a weighted average cost of inventory. So the newer inventory will be at the newer raw material pricing, and the older inventory will be at the older. So because of the raw materials increase in price, the inventory valuation does not dramatically change.
No, but it could change because of the NRV increase, right? The net realization. I mean, it's cost of realization, whichever is. Okay.
Yeah.
So yeah, blended it does not change much.
Yeah, exactly.
No. I'll just interrupt here. It is cost or realizable value, whichever is lower, not higher.
Correct. Lower. Correct.
Yeah.
Sure. And secondly, even if I exclude advertising expenses, your other costs have actually, fallen or are flat on a YOY basis. What is the key contributor to this?
Which costs, Vaishnav?
Your other expenses, ex of employee.
See, it's hard to compare with last year, because last year was a COVID-related year, and this year also has been a COVID-impacted year. So we've kept costs low. Even like if I take the advertising cost, like I was mentioning, we kept it very low, as low as 1.2%. So from a bottom line perspective, we have kept costs low because this has been a COVID-impacted year.
Thank you. The next question is from the line of Gautam Rathi from CWC Advisors. Please go ahead.
Hi, Gautam. Thanks for taking my question. So, Gautam, I just wanted to understand one thing. So, you in the earlier part of the call, you alluded that you have a run rate of about 47 to 50 crore per month of revenue, right? So, if I just do a back of the envelope calculation, it says that we should have somewhere around, we might have lost somewhere around 25 crore of revenue maybe in Jan due to Omicron. So, is this understanding right? And if it is, so how should we think about then the gross margins at a normalized base, right? Because this base would not be the right to think about. So can you just help us understand this?
Yeah, sure, Gautam. So see, you can assume that we've lost out 25 crores because of January Omicron variant. I mean, that's a right thing to assume. But from a GM perspective, see, like I told you, more than 97% of our sales happen on full price, irrespective of the channel, right? So for us, our GM does not really get impacted because of lower sales. Our GM pretty much stays consistent.
So Gautam, just wanted to understand, is it right to say that your GM last quarter was 66, this quarter is 68. What is the right level of GM that we should be working with?
Last year same quarter we had a GM of 61%, and this quarter we had a GM of 61%. So I think the GM number you can assume would be 60 to 61% would be the right number to assume on a long term basis.
This is after taking into account subcontracting cost also.
Yes.
Okay. So 68% is slight bit of an aberration, right?
No,
68 minus the subcontracting cost of 7, right? Okay. So 61%.
61% is the right number to assume after subcontracting charge.
After subcontracting cost for the full year.
Yes, absolutely. So for the full year, the GM was 60%. For the quarter 4, it was 61%.
Perfect. And just one last question, if I may just, just wanted to understand this 50 odd stores that we have opened. Is it fair to assume that by next year onwards, they should start clocking a run rate of anywhere between 80 lakh to 1 crore on which is your normal expectation from a store? Is that a fair ask?
Well, difficult to assume like that, but from our past experience, we have seen that any store what we open kind of reaches some sort of maturity within 12 to 15 or 12 to 18 months. So we would be hopeful the stores that we opened this year, maybe by the end of next year, once it crosses 12 months or 15 months, it should reach some sort of maturity.
Thank you. The next question is from the line of Deepak Poddar from Sapphire Capital Partners. Please go ahead.
Yeah, thank you very much, sir, for the opportunity. So, sir, I just wanted to understand in terms of EBITDA margin. What's the range that we might be looking at, given the raw material inflation that we have seen over the near to medium term in terms of margins?
See, in terms of, so let me talk about pre-Ind AS EBITDA because that would give a better kind of idea. See, we would on a steady state basis look at about 20 to 21% of pre-Ind AS EBITDA as far as annualized is concerned. As the business keeps increasing, that there will be little upside in EBITDA because of better efficiencies of fixed costs. But 20 to 21% of pre-Ind AS EBITDA is what we are looking at. And if you take post-Ind AS, it would be about, if I'm not wrong, it will vary about on an annualized basis between 35 and 37%.
25 to 27%.
No. On post-Ind AS basis, it will be between 35 and 37%. And pre-Ind AS basis, it will range between 20 and 22%. Pre-Ind AS.
Okay. And the current quarter, our margins was around 33%. So that was largely because of lower revenue base, and that's the major reason.
No, one of the major reasons is COVID. See, because COVID is definitely, there was a COVID impact in quarter 4. There was a COVID impact in quarter 1 and quarter 2. So the EBITDA obviously has been a little lower side because of the COVID impact.
Yeah. So that impacted your revenue, right? So
yes, absolutely.
Okay. Now that's it from my side. All the very best. Thank you.
Thank you.
Thank you. The next question is from the line of Chirag from Value Quest Investment Advisors. Please go ahead.
Yeah, thank you for the opportunity. Sir, my first question was reason for higher other income in FY22 and how we should look this number going ahead.
See, the reason for higher other income in FY22 is also because of the larger cash balance what we've had. So we've had it in fixed deposits and mutual funds. So the reasons of higher other income is because of higher cash balance.
Sir, but if I see last 2 quarters, it is run rate is about 3 odd crore, whereas full year is around 21 crore. So I'm sure in Q1 or Q2 there is some exceptional other income which would have led to this 21 crore other income for full year.
No, that's because of Ind AS, Chirag. Because in Ind AS, waivers are also shown in other income. So because of waivers, what we get from so that's more of a Ind AS entry.
Okay. So going ahead, is it fair to assume the 3-4 crore run rate would continue, right? So it would get normalized.
It will be fair to assume that. Correct.
Right. And second was on inventory. So is it fair to assume again H1 FY23 will go back to this 95-100 days run rate, which is currently 150 plus?
So currently our average monthly sale, what we are doing, Chirag, is about is around 47 to 50 crores. So based on our current run rate, we are already at about 93 to 94 days of inventory.
But on a reported basis, in past you used to be at say 90-95 days. Currently on a reported basis, it is at say 150 plus. So maybe say 6 months down the line when things get normalized, is it fair to assume?
Yeah, on a 6-month basis, we should be able to come back to that number.
Right. And just lastly, gross margin guidance which you gave 60-61% is after considering the cotton inflation which we are seeing and the price increase we have taken. We don't see any impact on gross margins, right?
No, the 60-61% should continue. We've already factored in that.
Thank you. Next question is from the line of Vinod from Union Mutual Fund. Please go ahead.
Yeah, thank you for taking my question. I just had one bookkeeping question. Can you just tell us what was the rent you paid for full year of FY22?
Mohan sir, can you? I think it's around 57 crores. I'll ask Mr. Mohan to confirm.
57 crores.
57 crores of rent we paid.
57.25 crores of revenue.
Sorry, and how much was it like? How much of it was on a variable basis and how much was fixed?
It will be largely, it will be more than 90% of it would be fixed. Variable would be a very small component.
Okay. Thank you. That's all from us. Thank you.
Yeah.
Thank you. The next question is from the line of Binoy Jariwala from Sunidhi Securities and Finance. Please go ahead.
Yes, hi Gautam. Thanks for the opportunity. I just wanted to know what is the Ind AS impact on PBT for FY20 and FY22?
See, the PBT impact would be not very different. It would be little different. I mean, I would see, like for example, if I take fiscal year 20, as far as I remember, the difference between PAT on a Ind AS and non-Ind AS basis was only 3-4 crores. So the delta difference between non-Ind AS PAT and Ind AS PAT is not too much.
And the 3-4 crores means the non-Ind AS PAT was higher and the Ind AS PAT was lower, right?
No. The non-Ind AS PAT was higher. You're right. Ind AS PAT was lower. The reported number was lower.
This is in FY20. And what about FY22?
FY22 also, Mr. Mohan, how much would be the delta?
Yeah, no. You have to stand corrected, Gautam. For FY20, it was around 8 crores was the effect of Ind AS. 116 particularly. The 115 another.
No, 116 Ind AS.
Yeah, 116. So FY20 was 8 crores, is it, at a PAT level?
Okay, and what about FY22?
Participants, please stay connected while we reach Mr. Mohan back to the call. Participants, please stay connected while we reach Mr.
I think he dropped out.
So I'm trying to reconnect him. Participants, please stay connected. All right, we have the line for Mr. Mohan connected.
Sorry, I got disconnected in between. I didn't know that. I was trying to see.
Mr. Mohan is asking what is the impact on PAT in fiscal year 22 and 20 because of India?
Yeah, I'll explain. In this fiscal year 20, the impact of India is 116 is around 8 crores. And this is now presently around 7 crores. This goes because this impact of PBT on India's on PBT will be always there because we are signing up new properties and renewing the old one. So there will be a renewal of the old one, and the closure of the engagement of new one. So the impact will be around 7 to 8 crores on a continuous basis.
Understood. And this is the impact, the 8 and 7 crores respectively that you've spoken of, is the PAT impact, right?
Yeah, it will be the PAT.
PAT and PBT both. I don't know. There won't be any difference on that.
Yeah, it will be the PAT impact. Yes.
Okay. And likewise,
so the reported number would be 7 crores lower or 8 crores lower.
Understood. Fair enough. Thanks so much. Second and last question is, what percentage of our contract manufacturing is where you buy you provide the raw material to the contract manufacturer?
Largely. So for us, majority of our sourcing happens through that model, where we buy fabric and then we give it to the subcontractor to convert it. So hard to give a percentage right now because that will vary from quarter to quarter, but majority comes from that model.
Is it possible to give on an annualized basis where you look to maintain this percentage in a particular range or something like that?
Sorry, I'm not having that number handy, but I'm from what I understand, it will be more than 70% of our entire sourcing happens through where we buy the fabric directly and give it to the subcontractor for conversion.
Understood. That's it from my side. Thank you so much.
Yeah, no problem. Thank you.
Thank you. Next question is from the line of Ankit Babil from Subcom Ventures. Please go ahead.
Yeah, sir. Two questions from my side. Could you please let us know the seasonality of your company on a quarterly basis? Like Q1 pertains to what percentage of your total yearly revenue and what other quarters, contributes. And my second question is sustainable working capital days going ahead, assuming normal environment with a breakup in inventory days, receivable days, and payable days.
Yeah, sure. See, from a seasonality or sales perspective is concerned, we see very little seasonality from a sales perspective because quarter 3, of course, being the highest, quarter 3 usually contributes to about 33 to 34% of the business. And the balance, quarter 1, quarter 2, and quarter 4 are pretty much almost the same. Quarter 4 is being the lowest. Quarter 1, quarter 2 are similar. So quarter 3 would be about 34%, and quarter 3 would be about 34%, and quarter 4 would be about 18 to 19% as a contributor. And quarter 1 and quarter 2 would be similar. And on the second question, sorry, what was the second? The second question was on working capital.
Sustainable working capital and a breakup between inventory, receivables, and payable days.
Sure. So on a sustainable basis, we look at a working capital days from anywhere between 120 to 130 days. So inventory would be 90 to 95 days, and receivables would be about 30 to 35 days.
Receivables would be 30 to 35.
Correct.
And payables?
Inventory would be 90 to 95 days. Payables would be about 10 to 11 days.
10 to 11, that's it. Okay.
Yeah.
That's it, sir. Thank you.
Yeah.
Thank you. The next question is from the line of Parikshit Shah from Dero Capital. Please go ahead.
Yeah, hi. Thanks for the opportunity. My first question was on the gross margin. I think, Gautam, in one of the earlier questions you responded, you expect margins to be around 60-61%. I just wanted to clarify, this is on a steady state channel mix, right? And I'm guessing that as EBO improves, the 60-61 can actually head higher. And second question was on EBITDA margin. I think you said you're targeting 20 to 22% pre-India's. Just wanted to know what the pre-India's margins were for Q4 and fiscal 22, if you can help with that.
Yeah, sure. So see, yes, 60 to 61% are the current gross margins. So as the the channel mix changes and gets more skewed towards EBO and online, we see this gross margin definitely improving beyond 60-61. But on the current channel mix, we are estimating that 60-61% should continue. As EBO sales increases, this gross margin will further improve. Difficult to quantify how much will it improve, but it will definitely improve. As far as EBITDA is concerned, we are having an EBITDA of about 20-21% on a normalized basis. Without the impact of COVID, we are having about 20-21% of EBITDA for the year. For quarter 4, if I take the pre-Ind AS EBITDA, we were at about 18.9%.
Understood. So this was basically the impact of the January wave of Omicron.
Yes, absolutely. Absolutely.
Okay, thanks.
Thank you. Ladies and gentlemen, due to time constraint, that will be the last question for today. I now hand the conference over to the management for closing comments.
Thank you everyone for joining us. I hope we've been able to answer all your queries. We look forward to such interactions in the future. We hope to live up to the expectations of you all in the future. In case you require any further details, you may contact Mr. Deven from SGA, our investor relations partner. Thank you again for joining.
Thank you very much. On behalf of DAM Capital Advisors Limited, that concludes this conference. Thank you for joining us. You may now disconnect your lines. Thank you.
Thank you.